Let's just finish up with Metropolitan and Momentum and the merger that has been announced today. You are a holder of Metropolitan, and I go back to the fact that you did say last week that it's the best kept secret in the market. You've made money, 12% up on the share price today, 11.79%, 16 Rand 88. So do you bail at this point?
I would remain in it, being invested on behalf of our clients. We've looked at the numbers quite closely, and we feel that should the deal go through at these type of levels, it would still imply that Metropolitan is trading at about at a 15% discount to embedded value. And there's always the possibility going forward that earnings will surprise on the upside, that they will be able to extract costs in terms of efficiencies, synergies, etc. But I think the big question...
What about the question that you're going to ask yourself, and that is about the dividend? What's going to happen to it?
Yeah, and I think there's a large part of the shareholder base of Metropolitan has historically invested in the company for its dividend yield. It's probably at about 7 or 8% at the moment. In fact, it's 60 cents with the last day to trade tomorrow, and the dividend cover of the share has been typically between 1.5 and 2 times cover. And I saw in earlier interviews with the first rank CE that he wasn't going to be drawn into a debate about what's going to happen to the dividend in the future with Metropolitan. But I think if one drills down into the details of the Momentum results over the last couple of years, it would seem that they have a dividend policy of about 2.5 times cover. So that would imply to us that there will certainly be some expansion in terms of the dividend cover, meaning that the dividends are likely to be slightly less going forward. But I think shareholders will be more than offset for that by the narrow discount to embedded value that the company will trade at.
Let's talk Capitec. 94.55 is where it ended, up 2.2%. A superset of results out from the group today, 44% higher at the headline earnings per share level, and certainly they're sitting with an ROE, a return on equity, of 32%, which really leaves the other banks standing in the dark. The big question there is whether the positive momentum on Capitec can continue.
I think so, and it probably reveals a greater story within the financial services industry. And there are a lot of people who constantly berate the high costs, monthly costs they are charged in terms of their banks. And there are a lot of people in the upper end of the market who are switching to transactional accounts with Capitec just because of the low fees that the business does offer. But going forward, the business has always surprised historically on the growth. If you plug the historical numbers into any sort of valuation metrics, the business looks expensive. But it's focused in a segment of the market where they've been able to gain traction quite quickly, and there doesn't seem any end to their growth. And management alluded to that fact in their results. I think they said they've got 420 stores, 422 stores. All of them are profitable at this stage. And to them that means that they need to open more stores. And as a side thought, I also noted in their results that they said Credit Suisse recently conducted a survey globally about the best global brands for tomorrow, and there were 27 companies mentioned in that survey, only one from Africa, and that was Capitec.
Does that mean that you are buying Capitec at these levels?
I think it's one of those shares, and you can throw the likes of Aspen and Shoprite into the same mold. Is they're just constantly able to expand and garner growth. And I think the important number probably to look at for the results was their bad debt numbers and their provision for bad debts, and that certainly seems to have bottomed. And I think that's a good indication for businesses like Able as well.
Very quickly, I see Moody's has revised its rating outlook on Anglo American, and that is too stable from negative previously. Hasn't moved the share price. We are pretty much in line with the market, 0.5% higher. Very quick comment from you on Anglo American.
Yeah, I think no one takes the ratings agencies that seriously anymore.
You said it, not me. Huh?
But I think in Anglo American itself, subsequent to the year-end results, we have seen some nice increases in the consensus earning forecast for the business for this year and next year, and I think that's improving the overall sentiment towards the share.